Hey everybody, welcome to your weekend review for the week of October 24th, 2022. And oh, what a week it was. Monday, things started out moderately stronger in the overnight session as gradual gains in Asia followed another apparent intervention from Japan. Weaker PMI data in Europe failed to inspire much follow-through, but tens nonetheless made it as low as 4.127 before bouncing back around 4:15 a.m. That wasn't the last bounce of the day though. Bonds rallied again heading into the domestic hours with yields nearly hitting the lows as they rode the coattails of the best daily rally in EU bonds, where we start the day down 10 basis points as stocks were gained. They're up 26 early before ending the day up 45 points more or less. There's been a lot of talk about the 2-year yield exceeding the 10-year yield and its correlation to the recession. Now, last week, the 3-month yield actually broke above the 10-year yield for just a little while last week, yet another sign of a coming recession. Nick Timiraos, the Fed reporter guy, has reported that the 0.75 November hike is pretty much locked in and ready to go, and the Fed is deciding how they're going to hit towards smaller increases in December, probably at 50 basis points. Big news this week will be the core PCE reading. It's expected to go from 4.9 to 5.2, which is in the wrong direction. At the end of the day, we ended up being down 9 basis points after briefly being in positive territory. We're right in the middle of that big range, bordered by a ceiling of 99.031 and a floor at 96.984. That is a wide range, so it'll be very bouncy. Really liked Matt Graham's news on the day, or how he relayed today's news, is the average over the past few weeks and months have seen a high level of intraday volatility, ultimately resulting in weaker trading levels for bonds. In that sense, today was very average. Domestic traders were lined up to sell after watching yields dragged lower all night. Then sellers succeeded in pushing yields up to 4.291 at one point before short covering trades chased the EU rally into the noon hour. Chase is a relative term though, considering the big underperformance. The last time British yields were this low, 10-year treasuries on the US were around 3.75 versus basically 4.25 right now. After that, bonds drifted uneventfully weaker to the highest yields in more than a decade. Just another day in 2022. And then the bond market finally got a win on Tuesday the 25th. The appointment of a new prime minister in the United Kingdom kicked off an active European trading session. MBS were up 73 basis points on the open. We also got a lot of home data. We got the FHFA Home Prices Index, which came in at minus 0.7 month over month, still up 11.9% year over year, which is a little bit slower than the 13.9% annual rate last time around. Case-Shiller came in down 1.3% month over month versus being down 0.7% the previous month, still up 13% year over year, which is very healthy, though it is a deceleration from the 16% it showed previously on a year over year basis. Profit and losses aren't usually thought of as a consideration for central banks, but the rapidly mounting rating at the Federal Reserve has many peers wondering if that is going to turn into a consideration. The bond market is enduring its worst sell-off in a generation, triggered by high inflation and aggressive interest rate hikes. Falling bond prices in turn mean that there are tons of paper losses on the gigantic amount of bonds being held by the Federal Reserve. Rate hikes also involve central banks paying out more interest on the reserves. Commercial banks park with them. It's tipped into heavy operating losses for the Fed, so that could come into consideration. The UK Treasury is already preparing to make up for a loss at the Bank of England. Consumer confidence retreated in October as well after advancing in August and September. The Present Situation Index fell sharply, suggesting economic growth slowed to start the quarter 4. Consumer expectations regarding the short-term outlook remain dismal. The October Purchasing Managers Index declined from 49.5 to 47.3, below the estimate of 50. 50 is the midpoint between expansion and contraction, so it has moved into the traction area, which is probably good because we need to see that in order to get rid of this inflation. We also got a 2-year Treasury auction, which came in at 4.46 versus 4.447 expectation. The bid to cover came in at 2.59 versus a 2.57 average. Strong demand, but higher yields. Bonds are already coming off the best levels of the day. They seen just before the noon hour. The weaker auction gave short-term bonds a bit of a push, which is going to make it even more inverted. At the end of the day, we were up 77 basis points on the day, landing at 98.52 on the 5.5, which has us in the top end of that very wide range, which is bordered by a ceiling at 99.031 and a floor of 96.984. We also got a post from our sponsor at WellThatMakesSense.com. This is from our series on the book Persuasion by Robert Cialdini, genius at persuasion, and all the things that go with influencing people. This is about the front loading of attention. So persuasion practices create windows of opportunity that are far from propped open permanently. So this is how you can create the environment to be more persuasive before you actually try to influence people. So check it out on WellThatMakesSense.com. On Wednesday, October 26th, bonds got a nice rally in the overnight session by their own volition. U.S. traders didn't push back against any movement seen during the overnight hours, so we started the day being up 28 basis points and stocks were down 24 early on. Friday's PCE inflation data is not likely to show any big improvement since it is the same time period as this month's CPI inflation data that showed higher inflation. Still, we're a week away from the Fed meeting, and if markets want to continue to believe that the Fed is going to be ready to start pulling back a little bit, that will help interest rates. We had a letter from Ohio Senator Sherrod Brown that he sent to the Fed asking them to slow down on the rate hikes, making the case that the hikes will tank employment and reminding them of their dual mandate, half of which is maintaining high employment rates. Odds are still of a 0.75 increase in November and a half-point increase in December. We also got new home sales, which fell 11% in September at a 603,000 annual pace, stronger than the estimates of minus 13%. Sales were down 17.6% year over year. There were 462,000 homes for sale at the end of September, but only 56,000 or 12% were complete. So this goes back to my continuing complaint about builder sentiment. You are still selling homes at a faster rate, way faster rate than you can even possibly build them. And things are bad in your world, especially when the median price rose 8% last month. So your sales price went up 8% last month. You're selling stuff still way faster than you can possibly build it, and your sentiment is down. I'm just going to call them crybabies. News reports are that 24% of Pulte contracts were canceled last month. Redfin said that it's 17% on existing homes. However, this is another chunk of information to take with a grain of salt because last year when rates were great, 14% of contracts were canceled. So it's not a big change. Reports are that 22% of homes had price drops. Another thing to take with a grain of sand because if you try to sell a $500,000 home for $540,000, but you decrease the price down to $520,000, is that really a price drop? Still, 46% of all home sales had multiple offers. At the end of the day, we were up 31 basis points on the day, which was a bit of a retreat versus midday gains that were around a half point. We are still in the upper half of that wide range with some new technical data. We have the 25-day moving average at 99.141, which is a little bit higher than the 98.83 we closed at today. So hopefully we can make a run and get up into that new range tomorrow. We also had an earnings call from Mortgage REIT AGNC, which is a huge buyer of mortgages and mortgage-backed securities. They discussed how wide MBS spreads have become. This means that the spread or the amount of interest rate differential between the 10-year Treasury and the 30-year mortgage-backed security is at some pretty close to all-time highs. Spreads right now are wider than they were in December of 2008 when the financial crisis was peaking. They're wider than they were in early to mid-2020 when basically all buying was frozen by these REITs, beset by margin calls. Can they go wider? Sure. But we're seeing historically unprecedented market, and these spikes don't last very long. Over the past 10 years, MBS spreads have averaged about 78 basis points, and they're at 190 right now. So that means that if the 10-year yield stays the same, there is a built-in improvement of up to 112 basis points on mortgage rates. In other words, we could see rates fall in the low 6% range over the next few months, even if the Fed continues to raise rates and the 10-year stays where it's at. Although the 10-year won't stay where it's at, though there is some chance of improvement just by easing of risk. So keep that in mind. And then Thursday the 27th was a day for the nerds. Lots and lots of data coming out. All in all led to a pretty good day on the bond market. First, we got Q3 GDP. The first read came in at up 2.6% on expectations of 2.3. This is after 2 consecutive quarters of negative growth. So for all the people that thought that that was the only qualifier for being in a recession, does that mean we're already out of the recession? Gonna have to think on that one. Keep in mind that this is the first of 3 reads on the number though, so it could change. The increase was driven by an uptick in consumption as well as government spending. Housing was a drag on it. Trade was also a positive contributor as exports increased and imports decreased. Personal consumption expenditures inside of this, not the true PCE, but within this, rose 1.4%. Both numbers were better than expected. The price index rose by 4.2% compared to an increase of 7.3% the last quarter. Excluding food and energy, the price index rose 4.5% compared to 4.7% in the second quarter. Inflation news pushed the 10-year bond yield back below 4%. Jobless claims came in at 217,000 on a 220 forecast. This is on a previous of 214. So we have a positive GDP and a good jobs claim. So that's going to definitely go into the Fed decision next week. Durable goods came in up 0.4 on a 0.6 forecast. It was 0.2 previous, so it didn't hit forecast, but it was still better than last time. Durable goods, excluding aircraft, were down 0.7% when it was expected to be plus 0.5. It was plus 0.8 previously. Bonds were steadily weaker in the overnight session, with more selling occurring at the start of the European session. The ECB announcement delivered a dovish hike with the as expected 0.75 increase flanked by ongoing reinvestments in the bond buying program. Domestic trading has brought us back to essentially flat on the open of minus 0.3, but on the day we ended up being up about a half point, which is good. Reprice on the day was moderate. And other economic data, durable goods orders went up like we talked about. Buyer affordability took an enormous hit in September with the 0.75 point jump in mortgage rates. It led to typical house payments rising $104 in August based off of a median loan amount in September of $305,550, which is much lower than the peak in February of $340,000. On the day, we ended up being up 53 basis points. We also got a great note here from econ70.com. Very, very smart guy. The problem facing the Fed right now is that monetary policy works in long and variable lag. The International Monetary Fund reports that rate changes have peak impact on GDP after a year, but on inflation after 3 to 4 years. Other recent research pegs peak inflation impact in developed nations at 2 to 4 years. This suggests that the Fed's difficulties are just starting. They will soon slow, then stop rate hikes, yet inflation will remain elevated. Been talking about this for a while. If you look at the graph of the 80s inflation curve, it took several years for it to get back down and out of recession. We also got a new post from WellThatMakesSense.com. So here's something you actually have control over: how much persuasion you have on your environment to sell more. And to get more persuasion, you need more persuasion. The concept of privileged moments identifies the points in time when an individual is particularly receptive to the communicator's message. So this book is all about setting up an environment so that people are ready to be influenced before you seek to influence them. We also started doing daily posts to this week, so we got the daily post from yesterday. Then we come into Friday. The UMBS went from down 19 basis points to down 34 basis points while I was writing my opening post. Bonds were moderately weaker in the overnight and continued to push the day's weakest levels despite PCE coming in 0.1 below forecast. So the PCE inflation on an annual basis, prices rose 6.2%. The core PCE year over year came in at 5.1% versus a 5.2 forecast. It was 4.9 previously. This core number is the big one that the Fed looks at when they make their decision next week. And reminder, they want that to be around 2%. Personal incomes rose 0.4% month over month in September. According to the BEA, spending rose 0.6% month over month. Yay, spending more than we make. Welcome to America. Employment cost index was 1.2, which was a 1.2 forecast and 1.3 previous, so that's staying pretty consistent. Third quarter employment cost index rises 1.2% matching index, or matching estimate. Rates are projected by economists served by Bloomberg to rise another half point in December, then by quarter points in the following 2 meetings. So all the projections are next week we'll get 3/4 of a point, a half point in December, and then quarter point increases into next year. The Fed forecasts released at the September meeting showed that rates reaching 4.4% this year and 4.6% next year before cuts in 2024.
If the Fed's dot plot in December indicates that the tightening cycle is largely done, I expect bond investors to flood back into MBS, since you get a government guaranteed rate of return far in excess of treasuries. That will cause a furious rally in MBS with a corresponding drop in mortgage rates. We talked about this earlier in the week, that there is a big spread between treasuries and MBSs. So once the Fed dot plot indicates they're done tightening, that should narrow down. So we don't need the overall bond market to get better for mortgage rates to get better, which is why a lot of people are predicting rates around 5 next year, beginning of next year at least. Pending home sales fell 10.2%, ouch, in September, according to NAR. MBS are now down. At the end of the day, we ended up being down 27 basis points at 99.09, which is just above that 25-day moving average at 98.997 all day. We were pretty much straddling that 25-day moving average, which is right in the middle of that bigger range at 100.141 and 96.891. Such a wide range in there. It does allow for a lot of volatility, as you've seen this week in the graph. In a report from folks that were at the MBA conference in Nashville this week, Secretary Marcia Fudge gave a very balanced look at the pros and cons surrounding MMI Fund's current 8.03 capital ratio. A lot of people are asking for HUD to lower the upfront or the monthly MIP on FHA, VA, and USDA loans. However, she made the note that in addition to the report highlighting there is an elevated serious delinquency rate, and the fact that the fund's capital ratio went from 7% in 2006 to just 0.53 in 2009. So things can move fastly, even though it has been overfunded for 6 years in a row. They're still worried about what could happen coming down the road. So there might be some changes, but don't hold your breath. Looking at next week, we have a big week coming. So it's jobs week. So we're going to get ADP payroll on Wednesday and non-farm payrolls on Friday. But the big one is right there on Wednesday, the FOMC rate decision. So everybody's going to look at the statements that come from that. It's pretty much accepted that they're going to increase it 0.75 of a point. However, the things they say about future tightening is what everybody's going to pay attention to. And then we're also going to have Bank of England. We've been hearing for the last several weeks about how the bond market is pretty much set before we even wake up because of all the craziness in England. So we'll have to see what they have to say about things on Thursday. Have a great weekend. Everybody get some relax because it's going to be a volatile week next week. And if you have some extra time and you want to improve yourself, your knowledge and things, check out our sponsors, especially WellThatMakesSense.com, and learn about some things that will actually help you sell more and make more money. Have a great weekend and be safe.